Hello and welcome to the latest video update for the Henderson Alternative Strategies Trust. Today I'm joined by James de Bunsen and Pete Webster, co-fund managers of the Trust. James, Pete, thank you very much for joining me. Firstly, tell me a bit more about the Trust performance since December.
Okay, so we think performance can be split into two key periods. So December saw weakening global macro and a Federal Reserve that were tightening monetary policy. This did put markets on the back foot, and you saw global equity markets fall sharply during the period. So during December, the world equity benchmark was down 7%. In light of this, the fund performed extremely well. So a number of our idiosyncratic holdings performed extremely well, meaning that the share price of the fund only fell 1.3% during the period. 2019 has seen a strong recovery in world equity benchmarks. This is primarily driven by optimism over US and China trade reconciliations and positive prospects on a positive result to the trade negotiations. On top of this, the Federal Reserve also made a number of positive noises, stepping back away from their tightening policy. The fund has caught a lot of the upside of world equity benchmarks that have recovered all of their losses from December. The fund is currently up 4.5% year to date.
So looking at the portfolio, there are usually some interesting names in there that you do well to find anywhere else. Can you tell me if there have been any new additions at all?
Well, actually, one of the new positions we've taken since we last made a video update was an investment in 3i plc, which actually is quite a mainstream private equity holding. This we view as a very much this tactical type of trade that we occasionally do. And 3i's share price was hit quite hard in the fourth quarter, and partly just general market turbulence, but also I think particularly because it was a UK listed stock. And there was general fear about a hard Brexit. 3i tended last year to trade at a premium to its net asset value of between 25 and 40%, and we were able to pick up the shares at NAV. So we thought that was a great time to buy a high quality private equity manager, which has a fabulous track record, and actually we think is very conservative in how it values its underlying companies. But that we think will be a fairly short-term position, and it's already done very well for us year to date. It's up over 20% in 2019.
And what about any positions that you may have exited or trimmed down at all?
Okay, so we haven't made any other new investments during the period. However, we did take the opportunity to top a number of favoured holdings. These included Princess Private Equity and Sigma Capital Group. In terms of sales, we haven't exited any positions in full, but we have reduced our positions in Riverstone Holdings, Biotech Growth Trust. We have also trimmed positions in Polar Capital Global Financials Trust, Biotech Growth Trust and Riverstone Energy Holdings.
So coming to the portfolio strategy, obviously we've had a rather muddled exit for the UK from the EU. There's been a slowdown of global growth, and obviously there's been a lot of rhetoric around the US and China trade wars. What are you expecting for the year ahead for 2019, and how are you aligning the portfolio in anticipation of this?
Well, there's been a very sharp rally in the first couple of months of this year. We think that's probably unsustainable. We think it's primarily prompted by, number one, the sort of slight thawing in the trade war rhetoric that we've seen and potentially a resolution there, but also potentially more importantly is the Federal Reserve's decision to basically put their monetary policy tightening on pause. And I think that was one of the key worries for markets and has encouraged this big rebound from December's falls. But at the same time, we don't really think this is sustainable because you're seeing weakening growth pretty much everywhere, and you are seeing a marked slowdown in people's expectations of how good earnings are going to be this year. And those two things, it's quite hard to see markets just ploughing on higher and higher. So as a result, we remain pretty conservatively positioned. We've already been taking profits on some of the more market-sensitive holdings, as Pete has just mentioned, and we remain focused on trying to find some more idiosyncratic, uncorrelated strategies in the portfolio, such as in the hedge fund sleeve, in our commodity sleeve, where we can, we've found investments and strategies that can protect returns quite well during volatility. So we think, the rest of the year could be quite bumpy because the data doesn't look that great. And we've still got all those other risks out there on the horizon, such as Brexit and other geopolitical events which will continue to trouble investors.